This week on Wealth Track, financial thought leader and legendary consultant Charles Ellis declares the index revolution is here and explains why investors should join it now, why passive index funds are overthrowing so many actively managed portfolios, is next on Consuelo Mack Wealth Track.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Thornburg Investment Management, Active Management Global Perspective, Rosalind P. Walter, and the Fairholme Foundation.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. The evidence is pretty compelling. 83% of actively managed U.S. mutual funds underperformed the market over the last decade. 86% of European funds did so. Investors are taking note. As a recent article in the Financial Times titled "Actively Failing" put it, clients are shifting en masse to index-based funds. Index tracking funds now account for 40% of the $9 trillion in U.S. stock mutual funds and exchange-traded funds, and the shift is accelerating in what Morningstar dubs Flowmageddon. Over the last 12 months, investors have pulled $308 billion out of actively managed mutual funds and poured $375 billion into passive mutual funds and ETFs. Are we at a tipping point in the shift from active to passive? Is this really in the best interest of investors? Do they really understand the risks and rewards of going passive? Well, a recent survey of affluent to high net worth individual investors found that more than 3/4 agree that index funds and ETFs are a cheaper way to invest, but 71% also believe they are less risky. That assumption is questionable. As the survey's sponsor, investment firm Natixis Global Asset Management, points out, since 1928, investors in the S&P 500 have experienced a 10% correction more than once per year and a 5% decline more than 3 times per year on average. The stock market does fluctuate, and at any given time, it is at risk of declining. Well, this week's guest is a globally recognized financial thought leader who has appeared exclusively on Wealth Track over the years. He is Charles Ellis, a leading consultant and advisor to institutions, endowments, governments, and high net worth individuals for more than 5 decades. Founder of Greenwich Associates, a leading international business and investment strategy consulting firm, which he ran for 30 years, Ellis has been studying how investment firms work throughout his career. He is the author of 17 books, including the investment classic Winning the Loser's Game, soon to be in its 7th edition. His most recent work is The Index Revolution: Why Investors Should Join It Now. I began the interview by asking him why the vast majority of actively managed stock funds are lagging the market.
Fundamental answer is there's been a change in place for 50 plus years of more and more brilliantly talented, hardworking, very well educated people coming into the investment management business, finding terrific equipment right there and ready for them, unbelievable access to information, and they're really good at what they do. And the only problem is there's so many of them that after fees, they can't possibly keep up with the market.
Now, you know that those of us who still believe in the ability of human beings to be above average.
Right. 80-20 rules.
And certainly on Wealth Track, we try to find the money managers who are above average.
The easiest thing in the world,
basis.
If you would like to be above average,
right.
All you have to do is say, I'm going to use my brains and I'm going to think about this question, and the easy answer, which I will arrive at with an hour of conversation at the most, is to index rather than this crazy thing called active investing, which used to work in a different environment. It doesn't work in this environment.
Right.
So if you'd like to be above average, that's easy, index. And you will be clearly, decisively, almost every year, and certainly every decade, comfortably above average. And lower taxes, and less anxiety and worry. And
However, if you index and you are buying index funds that are based on a market index,
Yes.
The fact is that you are going to have the market ups and you are going to have the market downs.
Yes.
Most human beings do not like to have periods where they're actually losing ground, and especially when it's dramatic, as we've certainly seen several instances in our lifetime. What about the theory and the practice? We will mitigate your downside losses, and that we will protect you in the downside, and that requires active management. What about that
That's an interesting idea. It doesn't happen to work because it turns out that active managers misunderstand markets about as often as they understand markets, and they gradually, over time, reduce their total long-term rate of return because they've got money in short-term investing.
Now, I am looking at a man who spent approximately, 50 some odd years advising pension funds and endowments and institutions on how to evaluate.
55, but who's counting?
Exactly. On how to evaluate active money managers to invest with.
Right.
Was there an aha moment, or was it, gradually the evidence was building up?
It was a very reluctant acceptance, first of all, that there was a real change going on.
Right.
Secondly, I was intrigued by the concept of efficient markets. So that helped, that I could figure out, because that's what I did my PhD in. So. And the third was, I watched my really smart, really hardworking, very well-informed, imaginative and disciplined friends kept having trouble, couldn't do it. Well,
consistently.
What the hell? If they couldn't do it,
right.
Who could?
Right.
And I'm talking about I had the privilege of working with the smartest, best people in the world, whether they were in London or in New York or in Tokyo or Singapore. It didn't make any difference where they were all having the same problem. If you read The Right Stuff, Tom Wolfe's wonderful book.
Oh, wonderful.
It wasn't that the pilots were making mistakes. It's what they were trying to do was so dangerously difficult that they couldn't help but make mistakes. And in the case of active investment management, the competition is so damn good that if your important skill requirement is other people have to make mistakes so you can beat them, because you can't beat them unless somebody makes a mistake. You can't buy low unless somebody's making a mistake in selling low. You can't sell high unless somebody's making a mistake in buying high. So you depend on the mistakes of others. And if they're all smart and they don't make any mistakes, it's like playing tennis against the bang board. And just hit it back every single time.
What about Warren Buffett? There are some studies out there that say basically there are some characteristics of great investors. They tend to be long-term investors. They treat their investments as businesses, so that they don't trade very often. They have skin in the game. They're disciplined. And of course, everyone cites Warren Buffett, but there have been other great investors over the years too.
Because he's just all you could ask for. He's brilliant, and many people say, he's really smart. No, he is brilliant. He has a fabulous store of knowledge, his recollection skills, and his withdrawal from the recollection basket of specifics is terrific. He is so focused on investing that he really concentrates on making decisions, makes very few decisions, considers making lots of decisions, but makes very few decisions. So guess what? He makes really good decisions. How much can you ask for? And you could argue, well, the assets that Berkshire Hathaway is now managing must be problematic. Of course, they are, very large. And he's having a tougher time than he used to have. Well, he says so in every annual report, and has said so for 25 years. It's getting harder, and it will get harder and harder, partly because his assets are larger, partly because the competition is better. There are fewer unbelievable bargains available now compared to 20 years ago. There were fewer then compared to 20 years before that.
Another change that's occurred that you had mentioned to me that is in your book as well is the fact that the costs for active management have gone up over the years. Can you tell us about that piece of it?
Well, there's a marvelous chart that the Investment Company Institute puts out that shows that the cost of mutual funds has actually gone down. That's true, but it's misleading because it's true that index funds have become a larger and larger fraction of all mutual funds, and index funds charge way less than actively managed funds. Actively managed funds normally have been increasing their charges if you take 10 and 20-year time frames.
Right.
12B1 would be one of those things. It's just another extra fee here and a little extra fee there. As assets get larger and larger per fund, the scale brings them down, but not nearly as much as you would have expected if you were in the bicycle manufacturing business or the washing machine manufacturing business. When you get that kind of volume, you would have thought the fees and costs would come way down. So that's one part of it.
Right.
Call it, they haven't changed that very much at all. The second thing is, why do we keep saying fees are four-letter word, single number? The four-letter word is only, and the single number is 1%. And you say, what's wrong with that? Just that it's a misunderstanding? Well, what would you like to have different? Well, 1% of your assets, but you already have the assets. What are you getting from the manager? Oh, returns. Fine. 1% of assets in a market environment where people are anticipating something like 7% returns, that looks like 15% fee as a percent of returns.
Right.
In the 1% of assets, 15% of returns, you can get the market rate of returns at just the market level of risk for 10 basis points. So you're paying 90 basis points or 99/10% more. You pay 90 basis points more to get a custom service called active investment management. Great. How much does that increase your returns? Sorry, it actually reduces your returns. So what is the fee?
Right.
Well, it's more than 100%.
Right.
Wait a minute. You can't have a service where everybody's buying it, everybody knows all about it, and it's 100% of the value added goes to the producer? Well, it's unique.
Technical innovation. 40 years ago, the index funds were created, and something like 20 years ago, ETFs were created. So we've seen a tremendous amount of innovation. There is a lot of firepower going into better investing, to get better results now, and we're seeing it in quantitative models.
To get better results or to reduce costs.
And right, well, reduce costs, better results and reduce costs. But, so looking at things like smart beta, instead of having market capital weighted indexes, the fact is, why not choose, a value-oriented index or a small company-oriented index or a index that only has companies that have consistent, records of profitability? And why doesn't that work, especially if you can combine them with low costs?
Right. Perfectly sensible thing, and it's exactly what we should all do, is find a way to do better than all the others. However, the others are out there trying to do better than us all the time too. And first of all, let's be clear. There have been two brilliant innovations in language in the world of finance. One was the day two Scots decided, it's a great product, Andy, but it's not going to sell. What do you mean it's not going to sell? Nobody's buying death insurance. It's a great product, but we've got to change the name. What are you going to change the name to? Try life insurance. It's been selling ever since.
Right.
Smart beta has got to be the second best naming there's ever been. It's just marvelous. Now, does it mean anything?
Yes.
Does it really mean anything of value? That's a different question.
All right, let me try one more approach, Charlie, before you can tell us what we should be doing. And that is, you have been on the board of some very successful financial institutions, and you have certainly, been in an advisory capacity for the Yale Endowment, which has one of the best track records of any endowment in the country.
Absolutely.
And they're active managers. So why can't, we participate in something like that? Are there other firms that that have mutual funds that we can do as well, or at least better than the markets, as the Yale Endowment has done?
No. I mean, it's
very
very disappointing to many people, but
right.
The truth of the matter is you can do better than other investors by indexing. You'll do much better than other investors if, instead of worrying about individual mutual funds or individual stocks, you think carefully about who are you and what's your reality. Do you have enough income so you're saving money? Are you young enough so that you can think in terms of 50 years? Are you able to learn enough about investing so that the ups and downs of the market you know don't matter and they don't disrupt you and cause you to get nervous and tensed up? Are you able to avoid, after a bad market that's been bad for a year or two and everybody's writing about how bad it's going to get, are you able to maintain calm and stay long-term knowing that these things do happen fairly often and that if you don't react, you're fine?
Of course,
all those things are really important.
Right.
And then how much time are you willing to spend on thinking about your family and yourself and what you're trying to do? And if you just could focus on those things, you can do yourself a world of good. I mean, really a major advantage.
But for our audience that don't have the luxury of a 60-year time horizon or whatever of investing, and
wait a minute. I look at myself, for an example. You say, Charlie, you were in your late 70s. You don't have 20 years. Okay, so I don't have 20 years. What am I doing making long-term investing? First of all, I would like to be sure that I've provided for my beloved wife, wonderful person, something I feel very serious about. I have children, and son of a gun, they have children. And the idea of my children and their children being able to get a good education appeals to me, and I think that's a nice thing.
But for retirees, for instance, in our audience, who basically want to make sure that they are able to support themselves in retirement.
Let's focus on that group.
Yes. So focusing on that group, many of them hold mutual funds, and many of them probably hold, several mutual funds. Should they be switching to index funds at this point? I mean, what's your advice?
Well, they shouldn't switch to index funds unless they would like to reduce the cost of activity, and they would like to increase the rate of return that they're enjoying.
Right.
And they'd like to stop being nervous about the market and individual stocks. And the investment organization they're working with now might get acquired by some gigantic insurance company, as often has happened over the last 25 years. If they want any of those things, but if they like to pay high cost, and if they like to be worried about individual stocks or individual managers, and all of that sort of stuff, and they don't mind coming in behind the market averages on a regular basis, and sometimes getting really schnockered, that'd be fine. But I haven't met those people yet.
So you're saying that basically all of us, no matter what stage of life, if we're investing in the market, we should be in index funds.
Let's say all of us.
Right.
I still think that Warren Buffett should not.
Right.
I still think David Swensen at Yale should not. And there are half a dozen other endowments that I feel the same way.
Right.
Certainly there are people who are absolutely marvelous at this kind of work who can, because of their experience, history, and their knowledge of individual people and their relationships, they can do slightly better. But they don't do a lot better. They do slightly better.
Choosing your index funds, what's your recommendation there? Because there are a lot more index funds out there. I mean, I know you've been a long-term advocate of broad diversification. So, Vanguard, you used to be on the board of Vanguard. They certainly have some funds that are total stock market index funds. Is it a one-stop shopping decision?
Pretty close, close. But let's take it seriously and go through the drill. Number one, if you're at all I just want to do some, the S&P 500 or the equivalent, a broad, diversified index fund. Focus on low cost and be sure it comes from a well-known, experienced provider of index funds. And there's several. BlackRock does it, State Street does it, Vanguard does it.
Right.
So, if you wanted to be a little bit more up to speed, rational, doing the right sort of thing, you should probably think in terms of more diversification, and you should probably have about half in U.S. stocks and about half in international stocks. Now, broad diversification is a good phenomenon. You might also say, well, I don't have as many little companies as I would like to have, so diversify in that direction.
Right.
That's fine. Whatever you're doing, just be sure that you say, I plan to stay with this for the long, long time.
So your view on ETFs probably is what? Jack Bogle doesn't like them because...
Well, Jack gets all upset about people trading. And
yes,
he's right.
Exactly. So, but your view on ETFs is?
I personally think you should be a very long-term holder, and therefore why should you pay for the privilege of being able to get in and out? Therefore, why not just go to an index fund?
You know, what about other asset classes? Bonds, for instance, commodities?
This is a theoretical question, Billy, but I believe deeply that if you're going to invest, you should be only interested in buying things that have a capability of increasing value by what they do, economic value added. I do not think that you should buy paintings to make money. I do not believe you should buy barrels of oil in anticipation that the experts who price oil are making a terrible mistake and you're smarter than they are and you could make a bundle by buying low and selling high. Do not believe anybody should buy gold in order to make money on gold. If they like to look at gold, that's fine. If that's their joy and pleasure to see it.
Or as a non-correlated
if there's some anxiety
asset.
They've got that there might be an invasion of the Martians and we might have to get out of here and you better take something that's valuable, that's lightweight, fine. I'd prefer diamonds, but you know, it doesn't make any difference to me because I wouldn't do either one, wouldn't dream of it, because I do believe that the world's going to work out.
But
and
bonds.
I do believe whatever you're investing in should be something that has productivity.
Right.
Now, bonds, I tend to be very independent, and I have to caution you. I believe that most people have longer than they realize and can live through more than they think they can. And a little bit of practice, and a little bit of studying history, they will be less anxious about things going up and down on their way through. And I would be more happy if more people would think more seriously about being more equity invested. And I think the cost of being in bonds, because the return is lower long term, the cost of being in bonds doesn't get fully recognized. I'm going to give you a personally strong held view. Teach a class at Yale on investing called Successful Investing. Students are asked on their first day to come prepared to answer the question, what percentage asset mix would you have at 30, 50, and 70? And the answer is 30% in bonds at 30, 50% at 50, and 70% at 70. There must be somebody that's got that on the internet. And then I say, why? And they say, because. And I say, no, that's not a good answer. This is a graduate studies at a great university. Why? And this awkward shuffling about that's not a fair question to ask, and you haven't even taught the course and you're asking final exam questions. Let me consider something. Do you have a whole picture of your finances? What do you mean by a whole picture? Well, for an example, you're going to get a job. How much would I have to pay you now so that you would give me every dollar you earn for the rest of your career? Jeepers, I'm not selling. No, you assume for a minute that you're going to sell, and all you have to do is set the price. What do you think would be a fair price? And it turns out to be a gigantic amount.
Right.
I said, okay, what is your salary most like? Is it most like a stock or most like a bond? Well, it's more like a bond. Fairly predictable, it doesn't flutter day by day, and so on and so on. So that's intellectual property. Your talent, your ability to earn a salary is pretty close to being a bond portfolio. And what fraction of your total wealth is that now? It's always 99.9 something %. Why would you take the small amount that you've got in securities and jam that into more limited income or fixed income? Why shouldn't you put it into equities? And then what you realize is until you get to be pretty far down the curve in time, you probably ought to keep more than you would have thought out of bonds and into other investments.
Very interesting. I wish I could take the class. Final question, which we ask every guest on the end of a Wealth Track interview, and that is if we had to own one investment for a long-term diversified portfolio, what would it be?
Index fund, broadly diversified, low cost.
That's great. Charlie Ellis, thank you so much for being with us once again on Wealth Track. Congratulations on your new book, The Index Revolution. Thank you.
A treat to be with you.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point involves Charlie Ellis's core recommendation for all of us. It is to spend some time and carefully think about who you are and what your reality is. What is your reality? What are you trying to do for yourself and your family? What's your savings plan? How long is your investment horizon? Can you handle the inevitable market fluctuations without freaking out? And unless you are really into managing your own investments, choose a basic indexing strategy and stick with it. As Ellis says, that choice will ensure you will outperform the vast majority of professional and individual investors. To spend some more time with Charlie Ellis and hear why he is so optimistic about the future, go to our website, wealthtrack.com, and click on the Extra feature. The website also gives you access to past interviews and action points. And to personally connect with us, keep reaching out on Facebook and Twitter. Thank you for watching. Have a great weekend and make the week ahead a profitable and a productive one.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Thornburg Investment Management, Active Management Global Perspective, Rosalind P. Walter, and the Fairholme Foundation.